If you're a Lloyds Banking Group customer with a mortgage and a payment protection insurance policy, you may be due a payout. Here's all you need to know. In 2011, the Competition and Markets Authority put in place what is known in short as the PPI Order. Now, this order set out a number of rules and obligations that the likes of Lloyds and other lenders that sell PPI policies had to abide by. Now, one of those rules was that they must send out annual statements to all customers setting out what it is they've purchased, what they're covered for under the PPI policy, what it's costing, and indeed what it covers. For the first breach, Lloyds Banking Group issued annual reviews to customers which failed to include the monthly PPI benefit figure required. This error affected approximately 8,800 customers for annual reviews sent in January 2013. Lloyds Banking Group reported that this issue did not reoccur in subsequent annual mailing cycles. For the second breach, customers received annual reviews where the correct monthly PPI benefit figure was displayed in the wrong box of the statement. In addition, the monthly benefit amount field was incorrectly populated with £0, but was correctly displayed in the type of cover field. This affected approximately 7,300 customers who have been identified to be an offset of the 8,800 customers affected by the first breach. Lloyds Banking Group reported that this issue first occurred in January 2014, and a system fix has implemented to correct this error in 2020. The third breach, approximately 54 customers received annual reviews where the monthly value of PPI within the type of cover field was incorrect. This issue first occurred on the 10th of January 2013 and continued until it was rectified on the 14th of September 2020. The customers affected by this breach were a subset of the customers affected by both breach 1 and breach 2. So what does this all mean? Well, if you had a mortgage with Lloyds Bank and you had a PPI, a payment protection insurance policy attached to that mortgage, and you were a customer between 2013 and 14, it means you may now be due a payout. Well, that's now the million-dollar question, because I've seen lots of people reporting that if you were a customer in this period, you will be due a payout. Wrong. The terminology should be you may be due a payout. And the reason why I'm saying this, if you look very carefully at the letter from the CMA to Lloyds, it's on the screen now, you will see that the language they are using clearly says that payouts will only have to be made where there's been a loss. So it says for all customers with an open policy affected by breaches, Lloyds Banking Group will send an apology letter. No one cares about that. For customers impacted by the third breach, Lloyds Banking Group will also offer affected customers with live and closed policies the option to receive a refund of premiums to cover the period in which breaches occurred. So what does affected customers mean? What does it mean where the customer has been affected by the breach? Very simple. In my view, it means if you could go back to them and say, if I had known how much this policy was costing, if I had known what the cover was, actually, I would have elected to have cancelled the policy, either because I didn't need it or because I could have bought it cheaper or got better cover elsewhere. In those circumstances, my view is you'll be entitled to a refund of the whole policy cost. Unless you can say that, Lloyds are probably going to say, here's an apology letter, that's all you're entitled to.